Hello, bankers. Welcome back to Learning Sessions. I'm Himanshi Malik, and today is the final part of your chapter 25C that we're going to discuss. So, in this particular lecture, we are going to finish the non-discounting method, non-discounted cash flow methods. Okay, for taking investment decision. In the previous two lectures, we have discussed the discounted cash flow methods, wherein we covered net present value approach and internal rate of return method. Both of them had their own benefit and disadvantages. So in the last where we concluded that IRR is a good method of appraising an investment, but it ignores time value of investment. It means it ignores the period in which we are going to get the same return. So to overcome that, we are going to use today's method, that is payback period method, and another method we will discuss that does not consider time value of money, that is accounting rate of return method. Okay, so before we go into this lecture in detail, if you want to study JIIB full course in detail, you can enroll in the JIIB early bird pack that is valid till exam. So in this course, in this module, we will cover everything in detail that is related to your JIIB syllabus, and we will ensure that you are perfectly ready for your exam. So to enroll in the course, you can either click on the link that is given to you in the comment box, or you can download the app Learning Session IBF Exam, which is available on Android and iOS both. By downloading this app, you will get access to all the courses that Learning Session is providing you, and you can enroll in them. So do enroll in the course and study together with us. So let's start with the today's topic, that is non-discounted cash flow method. So the first one is payback period method. Where we ended yesterday's lecture was we calculated the IRR on a project. I hope you were able to understand the calculation. So the limitation of this method was it ignores the time period of return. Even though the same returns may be giving us higher return. For example, we have project A, project B. IRR of project A is 15% and for B is 20%. If I only look these two aspects, IRR only, which project will I choose? B. But when I add one another factor, the time at which I'm getting return, in project A, I'm getting 15% return in only a year, but in project B, I'm getting 20% over investment for 5 years. Now, comparing just IRR becomes unstable and it cannot be completely dependable, right? We need a method that will also consider the time period of return. For that, we have our payback period method of taking investment decision. What do we mean by payback period? It is the time period, minimum time period by which we will get our initial cash outflow back. So the time period by which we will get our minimum initial cash outflow back is your payback period on a project. So firstly, we understood the IRR is the rate at which we are making no profit and no loss. Payback period is the time point in time in investment where we will have covered all our cost, and after that anything we are getting in return is just our profit, right? This is how happen in any investment. If I invest for 5 years, 1, 2, 3, 4 and 5. So if I've invested here for some time, the return will only cover my initial cost, and once my initial cost is covered, then the remaining part that I'm gonna get is going to be my profit. So this is the concept used in payback period approach. Okay, what does it say? Period in which total investment in permanent asset is paid back with additional earning generated from the investment. From preferred taking investment in proposal where capital invested is recovered fast as early as possible, right? So where we are getting, where the payback period is shorter, we are going to make investment in that project. Payback period is defined as period required for proposal's cumulative cash inflow to be equal to cash outflow. The payback period is usually stated in term of number of years. It is a period proposal to break even on the net investment, when we point in time where we will break even on the investment. The limitation of this method are, it is going to ignore time value of money. It neglects cash flow received after payback period, because we are only concerned with the payback, that is till our initial investment is covered. All the cash flow after that are ignored. So it does not tell us any profitability. It is only going to tell us how long is it going to take to recover the cost of investment. Does not consider project's return. So let's learn how to calculate the payback period on an investment. Calculation of payback period. So there can be two scenarios in calculating payback period. First one is where we are getting equal cash inflow. Okay. And the other one is where the cash flow in future is going to be unequal. Unequal cash flow from investment. And first one is where we have equal cash flow from investment. So if we're going to get same return each year, that means my inflow is equal each year. For example, if I invest 1000 today, and my return is for 4 years, I'm going to get 500 in return. So the formula to calculate the payback period is initial investment divided by annual cash flow. Initial investment is 1000, annual cash flow is 500. So the answer is 2 years. So what does this 2 year mean? It means when I've invested 1000 for 2 years, in the first 2 years, my original investment will be recovered, and the remaining cash flow that I'm going to get are my profit part only, right? But the disadvantage here is we have completely ignored the time value of money aspect in this, right? So this is the first formula, that is, if the cash flows are equal, payback period is going to be initial investment divided by annual cash flow. So how will you take investment decision? If you have two investment where everything else is same, you will see which investment is giving me return, higher return in lower period of time, and I will take that. Other cases where we have unequal cash flow, so we take the cumulated returns. Okay, so let's take the example. Just a minute. Investment is of 1000 only. Return is 1, 2, 3, 4. So we get the return, let's say 500 in year 1, 1000 in year 2, 3000 in year 3, and 1000 in year 4. So the cash flow is unequal. So to calculate payback period, instead of saying 1000 here, let's say 700 and 200. So this is the return. We will calculate cumulative return first. 200, 700, 500, 1000. So cumulative return will be Year 1 200, year 2 700 plus 200, that is 900. Year 3 900 plus 500, 1400. Year 4 it is 2400. Now I have taken cumulative return. What was my initial investment? It was 1000. I will compare 1000 with the cumulative return. So this is lower than investment. So this is not my payback period. This is also lower, not my payback period. But here my return is 1400 cumulative, higher than my initial investment. So what does it signify for me? That my initial investment will be covered somewhere around here. Between year 2 and year 3, my initial investment will be covered, right? So how do we calculate this? We take, so year 2 are going to be complete, plus 1400 minus 1000, the extra part that we need to cover, divided by the return that we will get in that year. It is 2 plus 400 divided by 1400 is equal to 0.285. So my payback period on this investment is 2.285 years, or in other words I can say, if I multiply 2.285 into 12, so 2 years and 3 months approximately. That is how long it will take for this investment to give my return back. And on the other hand, this investment is giving me my return in 2 years back only. So we can compare the time period of two investment and decide where in which we are going to invest. So when can we use it? For example, if I have funds only for limited time, then I will see which investment is taking lower period of time in giving me higher return. This method is used along with IRR, right? For example, we have taken here project IRR 15%, and here we had 20%. Time was 1 year and 5 year. Now, if we take another factor, payback period. Here the payback period is 1 year, and in this the payback period is 2.2 years. So which investment will I take? Higher return with lower payback. So I can make the investment decision like this. I hope you are clear on this method. So you note down this formula. So the first formula is the equal cash flow case. In that, the formula is very simple. Initial investment divided by annual cash flow, you will get your payback period. Where the cash flow are unequal, we have to first calculate the cumulative return, and from that cumulative return we will calculate our payback period. Now, this is the example that is given to us in the notes, that we have two potential projects that are going to cost 50,000 and they have net cash flow like this. So project A is giving these 5 cash flow and project B is giving 10,000 each year. So you can calculate the payback period now, right? In this case, how will we calculate the payback period? 50,000, because the cash flow are equal. 50,000 is our initial investment divided by annual cash flow 10,000. So the payback period is 5 years. Very simple calculation. Here the cash flows are unequal, so we calculate the cumulative part first. 7,500, 27,500 plus 15,000, 42,500 plus 7,500, 50,000 and 53,000. So when am I getting my return here? At year 4, my initial cash flow is recovered. So the payback period of project A is lower than project B. I can make my decision here. Initial cash flow is same, recovered in 4 year in project A and 5 year in project B. Therefore, project A has shorter payback period and we can invest in project A. When we will choose this basis, when time is of concern. Next method is accounting rate of return method. This is a simple rate of return method where you don't want to consider any time value of money. You just want to see what ultimate return I'm going to get. So very simple formula. We have to take average profit after tax that we are going to get from the investment divided by average value of investment. How do we calculate average value? Investment in beginning, investment at end divided by 2. That will be your average investment, and from here you can calculate your ARR. So we can calculate ARR if it is higher than the minimum rate of return set by the management. If management wants 10% return and the project is giving us 15% ARR, we can invest in this. This is very simple method. So hope you're clear on all the method: NPV, IRR, payback period, and the last one was ARR. Next topic is term loan. So what is a term loan? A loan that is given for a fixed duration and which is going to be repaid in regular installment, right? So some important point regarding term loan are, it is taken, normally we take term loan whenever we are going to acquire any fixed asset like land, building, machinery, infrastructure. So term loan are payable as per agreed repayment schedule, and in some cases bank can also provide to us working capital term loan. So loan that is not for fixed asset but for working capital, and normally working capital loan are for 1 year and payable on demand. So in working capital loan we do not have any repayment schedule. So why do we have to consider term loan? Because in making investment decision, two factors are important. The first one was return on the investment that we calculated with NPV, IRR, payback period, ARR, right? And the another important aspect was cost of the capital. So what is your cost of capital going to be? That can be the rate of interest on term loan that you have taken, right? Then another method is deferred payment guarantees. So what are deferred payment guarantee? That if we are purchasing a fixed asset from a supplier and we do not want to pay them immediately, but according to a agreed repayment schedule, instead of taking a loan, term loan for purchasing an investment, we can make an agreement with the supplier that we will pay the part in installment. For example, if the investment is of asset is of 1 lakh, instead of paying 1 lakh upfront, I can say I will pay you 40,000 in 3 installment. So this 40,000 in 3 installment covers the cost of the investment plus my interest rate for him, and that is your deferred payment guarantees. Next, project appraisal. Now, how do we project appraisal means assessing the project, how if you're going to undertake the project or not. Process of assessing in a structured way the case for proceeding with the project or proposal or the project's viability. That should we take on this project, that decision we are going to take here. What are the steps of project appraisal? First, appraisal of management aspect. Second, technical appraisal. Third, economic appraisal. Step 1, appraisal of managerial aspect. So what do we consider in this point? We need to seek the answer to the credential of the promoter. What do our promoters want? How much stake do they have in the project? What is the form of our organization? Who is the main person that is going to be affected by business? Because we have to make the decision according to them only. Then we take the technical appraisal of the project, where if is the project even feasible to be taken, what will be the location of project, what product are we going to produce, availability, do we have the required infrastructure, what investment will be needed, is the technology available with us, what will be the how will the construction go on, who will take on the project, how will we deal with waste disposal, all the aspect of any project from the very beginning, from starting the project to ending the project and cleaning up the site, we have to consider each and every aspect before we even decide. These are some non monetary factor that also need to be considered. Monetary factor we can consider with the help of NPV, IRR, but some non monetary factor we need to consider before taking the decision, and these are the factors. Then comes your third aspect, economic appraisal. That is the monetary factor we need to consider. That what is the return on project? So the usual method for calculating return are NPV, IRR, payback period, accounting rate of return, etc. Break even analysis. Break even is a point at which we have recovered all our cost. We are making neither profit nor loss. That is the break even analysis. And we only undertake project where we have high break even point, that one is risky because it will take more time to recover, but the project where there is low break even point, it will be recovered easily. Then we take sensitivity analysis of the project, that if the market condition change, how will my cost, how will my return get affected by this? That is also an important factor to be considered while taking a project. So as the market condition are uncertain, a small change in prices of raw material or finished goods may have a drastic impact on viability of the project. So we have to also take sensitivity analysis. That is how we appraise a project. First we did what? First we did managerial appraisal from the aspect of management. Will they be interested in this? Then technical appraisal. Is this project is even feasible? Can we make this happen? Third, economic. Is it profitable for us or not? That is how you take any decision. Then we have infrastructure project, the projects where we are going to invest in high cost technology like transportation project, building roads, bridges, inland waterways, airports, high stake projects we have. Energy projects are also high stake, like in electricity generation, transmission, distribution, oil pipeline. All these are high stake and high investment project. Again, water sanitation project are there, communication, social and commercial infrastructure. All these projects are your infrastructure, and here we have higher cost at stake. We need to appraise this project very carefully. Then at last we have syndication of loans. What is syndication of loan? When we need funds for a project, either we can take funds from one bank, but if the one bank is not willing to take such risk entirely on its own, we can get two or more banks to come together and fund our project, and that is called syndication of loan. This is a way of sharing risk associated with lending to that borrower by bank. It's generally used for large loan. And that was the entire chapter on capital investment decision. So were you able to understand this chapter, or you felt it was quite difficult or confusing? Let me know. What we did in this chapter, we have overlooked two methods, discounted method and non-discounted. In discounted, we have considered the time value of money, and important formula for you to remember here was calculation of present value, which is very simple, FV divided by 1 plus R into T. And we also saw PVF. So PVF was 1 divided by 1 plus R raised to power T, right? And from that you can calculate net present value of the project and also the internal rate of return. Internal rate of return is calculated as a point at which NPV is 0. For this, we calculate two NPVs at any rate and we interpolate the IRR from that. What was your interpolation formula? We take lower rate plus NPV at lower rate divided by NPV at lower minus NPV at higher multiplied by H minus L. So that was your interpolation formula to calculate the IRR. Then we did payback period. Payback period was the period in which our cost of investment will be covered. We ignored time value of money here. The formula we used was based on future cash flow. If the cash flows were equal, this formula was very simple. Initial cash outflow divided by annual cash flow. But if the cash flows are unequal, then we take cumulative cash flows and we see at which point our investment is getting recovered, right? The next method was accounting rate of return, that is calculated as average profit after tax divided by average investment. So this was your entire chapter in nutshell on making capital investment decision. First, you need to understand each and every method, why it is important, what are the limitation of each method, and there are only a few formulas for you to remember. I hope that you like this lecture. Please let me know in the comment your feedback so I can teach you in a better way. And if you have any suggestions, you're always welcome to give that. Thank you so much for your time. I will see you in other lectures like this only and help you complete your syllabus in a perfect manner. Bye bye.